Hello, this is SeeWing Yee from the Yee Real Estate Network. Uh, I'd like to take this opportunity to go over a typical real estate investment property. We feel, I feel the one about the show you, which I've been doing for the past 20 years, is that we believe the best asset class in a most in a historic way, the best real estate investment asset class is a single family home, residential investment. All right. So we're going to use a lot of assumptions. I don't really want to bore you too much with numbers, but I have to do it. So I'll be as brief as I can. It'll take this video will probably take 10 minutes, right? Just bear with me. Okay, I'm gonna share the screen. Here we are. And here we go. All right, so the assumptions I'm gonna start by saying that as a risk investor, regardless of where you live in any of the 50 states in the US or even overseas, you have the ability to buy investment properties out of state, right? Preferably, there are so many ways. I'm not gonna get into it. There's so many ways to invest in real estate, but today I'm gonna focus on something that we do. This is our niche. This is our business model, if you will. So, single family home, turnkey investments. These kind of properties is off market. We present this strictly to our member investors, which anybody can become our member for free if you just log onto my website, right? But I'm just gonna go over this analysis of a typical property that we like. So we invest in the market where the numbers make sense. Okay, regardless of where you live. Once again, you have the ability to buy remotely, to buy even potentially sight unseen if you trust your sources, which is sounds very mind-boggling. But yeah, so we believe over time, we've been doing this for almost 20 years, helping real estate investors to buy out of state properties in the best market. And the best market we feel are in Texas, Florida, and North Carolina. And our secondary market, we believe very highly, is Alabama and few Midwest states. So we buy cash flow properties, right? I mean, you can pretty much ignore the western side of the U.S. The properties, if the median price of a single family home in any market are around $350,000 or even less, that's the ideal, what we call it, sweet spot. That means we have to compare what type of renter are willing to rent your property so you can achieve cash flow. If you can put 20 to 25% down payment minimal, then you run the numbers. You have to determine what type of monthly rent are able to pay once you put the down payment, whether the rent you get will cover all your monthly debt obligations, including your mortgage, your property taxes, insurance, property management fee, and 3% vacancies or maybe 5% maintenance and upkeep that come out of your pocket. And at the end of the month, you still have positive cash flow. That means if you get a renter that willing to rent you $2,000, and the accumulation of all the debt obligation and expenses of managing or running this particular property is less than $2,000 per month, that means you have positive cash flow, right? So that's the key. So buying cash flow is the key. The appreciation aspect is really icing on the cake. That's just a bonus, right? So again, I know I'm using a lot of assumptions, but I'll digress. All right, so let's go with this single family home. It doesn't really matter, where it's located. In this case, happened to be in Central Florida. Single family home, 4-bedroom, 2-bath, 1,750 square foot, and it sells for $257,000. Again, this kind of property is off market. the builders in this community only sell to investors, and the assumption is you can have property management available to manage your properties. They do everything for you. They are your eyes and ears, and there's a team available locally where they can help you manage this property. And you as an investor, assuming that you're a mom and pop investor, I mean, you just manage your property remotely, far away, and you do very little work. Okay, you can maintain your full-time job and have you should be able, you should be able to so-called manage your real estate portfolio, whether you buy one rental properties or 10 or 50. You do not need to become a full-time investor, as long as the local team in each market, they surround you with very competent property management, and the team on the ground can help you over time, long term, to help you maintain your portfolio. So with that said and done, so here are the additional assumptions that I wish to make. You put 20% down payment on this purchase price, single family home, brand new construction. So the price is $257,000. You put 20% down payment. So your total out of pocket, including closing costs of $2,000, is a little bit less than $60,000. So the question you have to ask yourself is, this is your risk of investment, all right? So at the end of the day, how can you recoup your money in the next year to 2 years, right? Based on the accumulation of the cash flow, how many months of cash flow and how many months of appreciation potentially, down the road before you can recoup your investment. By the way, you're leveraging your money to buy this property. I mean, you buy this $257,000 single family home, income producing property where your tenants are paying down the debt for you. Is it an amazing scheme? Not a scam, it's a scheme, right? If you can find a high quality tenant that over time can pay off your mortgages and all your debt obligations, and in next 15, 20 years you become debt free. Your tenant, right? Your tenant is making you rich. That's the key, right? So that's how you leverage. That's how you work smart, right? You don't work hard. You work smart as a turnkey, mom and pop real estate investor, if you will. So bear in mind, your out of pocket, your at risk investment is $60,000 to buy this, $257,000 single family home. So the projected monthly rent is $2,100. So very desirable. You can find a high quality tenant these days for willing to pay you $2,100 every single month. And the vacancy factor, because the rental market is so strong in many areas of the country, we're becoming a tenant nation. Is only like 3% vacancy in this particular case. So your gross rent $2,100 minus vacancy factor. So your net operating income per month is $2,037. Then you pay your monthly property taxes, insurance, and property management fee at 8% of the rent. And some little bit of maintenance, 3 to 4% maintenance on an annual basis. And here are the monthly numbers. So your operating expenses per month is $549. So your gross rent per month minus the operating expenses, as we discussed, is equal $1,487. Then you get a 30-year fixed rate mortgage at a very, very low rate at 3.8%, which is amazing, right? Historical low rate, even for investment. So, and your monthly mortgage is almost $1,000. So your net operating income minus your mortgage payment equal at the end of the month a monthly cash flow of $529. Now that's pretty amazing, right? So then you look at the numerical formulas, which I'm not going to go into details. It'll take another hour to do so, but all the numbers make sense, right? Rent to value ratio is 0.8%. This is the benchmark, right? Capitalization rate is 6.9%, very, very good. Cash and cash return, 11%. I have other videos that talk about the numerical formulas. And your total investment is, at the end of the first year is 61%, which is amazing because I put down 10% first year annual appreciation, which is quite ambitious, but real estate has been doing well, at least the last a couple of years. But anyway, so the beauty of it is down the road, right? I mean, this is just the first year. If you project 10 years down the road, if you could survive the first few years, right, maintain discipline, if you have a good tenant, you have a good property management, you know, I mean, your property will be turnkey, really would be like a passive investing. So I'm not gonna bore you with any more details of the 10-year performance projection, but it's all about, you know, buying the whole situation. So each year, you know, as you can see, from year 1 to year 10, I can go beyond year 10, but again, I don't want to bore you with all these numbers. I don't want you to put you to sleep. But at the end of the day, you know, we can assume you have a 3% annual increase in your rent, although we've been getting 10 to 20% rent acceleration due to the situation was happening with the pandemic and the shortage of homes to buy and shortage of homes to rent. So, but I want to show you the big picture. I mean, you have to look at it long term. You have to look at the big picture, right? So that just overcome any kind of challenges and obstacles and keep on maintaining your property, have your tenant, pay down your debts and so forth, and let your property grow, let the property management do their job. So if you look at the annual from year one, I'm not going to go through all 10 years, but I'll just go over it from a high level, right? So your gross rent will continue to increase on an annual basis. Then you always have some vacancies, sometimes more, sometimes less vacancies, depending on the each situation. So your taxes, property taxes go up every year, but your rent also go up, right? So forth and so on. Then you look at the operating expenses, and then this software breaks down. I know, I mean, you don't have to be a mathematical genius or rocket scientist to figure out these numbers. I'm sharing with you some very conceptual information. So if you can maintain and this long-term buy and hold strategy, everything will work out, right? So easier said than done. So I mean, look, at the end of the first year, based on 10% appreciation and based on annual net cash flow, right? I mean, you're getting ahead. If you hold the property 1 to 2 years, you can recoup your down payment, right? So I mean, beyond that is gravy. Year 3, year 4 is all almost free money, right? Based on the assumptions, based on the tenant will continue to lease your property, continue to pay the monthly rent, annual leases, and so forth. But if you look at the four category, income analysis basically show you the annual gross rent minus all your debt obligations. Then you have your cash flow, annual cash flow. Each year continue to increase. Right, the first year of annual cash flow, if the monthly cash flow was $500 monthly net cash flow times 12 months, your annual net cash flow is $6,300, right? And then you if you can continue to get the 10% appreciation, you're probably going to grow, $26,000 from year 1 to year 2. Then if you continue to get 10% appreciation or even 7% appreciation, the compounding of your value of your house will continue to grow, right? So I know you're thinking, correction, crash, downturn. I'm not going to go into any more details. I'm just, again, this is just an illustration for God's sake. Okay, so each, this software can kind of from year to year, your appreciation gets higher, systematically speaking, and your principal payment gets reduced systematically, right? So you get your annual cash flow, you get your appreciation, right? And then at the end of the day, it shows you the equity gain from year to year, right? Based on this income analysis. So your return on equity, is quite substantial. First year 44%, second year 34%, third year 28%, and then look at your loan, right? As you can see, you start out with a 30-year mortgage based on your investment mortgage. Then systematically your loan balance gets paid down little by little, and then when your property increase in value, then your loan to value ratio, which is LTV, will get lower and lower. That means with your lower balance of your loan plus your continued equity gain based on X amount of appreciation per year, for example, this is your equity, right? The loan analysis tells you the equity you have on your property. So when you reach the loan to value of 50 to 60%, you have the ability to cash out refinance if you want to get the cash out tax free on the cash out refinance to buy more properties, right? The power of leverage. So if the value of your home at the end of the third year at 10% appreciation, you bought it at 257, at the beginning, at the end of year 3, based on 10% appreciation, the value of your home is already, as you can see, 342, right? Minus a loan balance of 193K, you already have an equity of 148,000. So if you want to cash out refinance your rental property, your loan to value is at 56%. So so you qualify to cash out refinance if you want to. So if you were to cash out refinance this equity 148K in the third year, the lender will allow you to do that. And then based on the LTV of 56%, here's the potential cash out refi. You see right here, you can cash out refi this amount, $113,000, and buy 2 or 3 more properties. See, just the first few years, based on equity growth, based on annual net cash flow accumulation, based on paying down the loan balance, you have more and more equity. So I'm not asking you to, cash out refinance. Whenever you cash out refinance, your payment is going to be higher. So if your rent still cover all your debt obligations after refinance, then it's worthy for you to do that. So you don't have to do anything. You can just not cash out refinance, hold the property, and keep on growing the property over year 4, 5, 6, 7, 8, 10, 20, 30 years. Pay all the mortgage, you're free and clear. There's so many exit strategies. I'm not going to go over too many more. But if you were to sell your property at 3rd, 4th, and 5th year, but you must understand, if you sell your property, normally you have to pay capital gains taxes. But I'm not going to talk taxes too much. But sometimes it's okay to pay taxes if you want to exit the property for whatever reason you want to sell. But if you want to sell your property and not pay the capital gains tax, you can do a 1031 tax deferred exchange. Again, that's another topic. We don't have time to talk about it. So this 4th category, sales analysis. Let's pick up the 4th year. The 4th year, based on the assumption of 10% annual appreciation, you already have an equity of almost $200,000. If you were to sell the property for whatever reason based on your goal, then the market value of your home minus loan balance equals the equity the 4th year. If you want to sell the 4th year, for example, for example assumption purposes, the value of your home is 376, right? In the 4th year, then you have equity 186K. If you sell it, the closing costs and other costs, then at the proceeds of the sale, it's 160 grand. $160,000 is a gross profit that you can pay your capital gains taxes. If you can outright sell and not do any 1031 exchange, then you walk away with $160,000 proceeds after the sale, then pay 20% capital gain, whatever, and you still pocket some very, very good money. So see, yeah, here's the projection. You set gross profit, so 160K minus the cost and taxes. Your net profit could be 130 grand, right? So you can walk away from this property at the end of 4th year. It still, makes out well, still, make some money out of it. But ideally, keep the property long term. Let your tenant pay off your mortgage. You can do a cash out refinance. You can sell the property, do a 1031, or you can hold the property. So all these numbers really, it's kind of hard to understand to some of you who are newbies. But there are 4 categories, right? So, or you can, based on your annual monthly cash flow, you could pay 1 extra principal per month and pay down your 30-year mortgage in about 8 years, right? So that's called mortgage debt, principal acceleration. Pay 1 extra principal per month, and your 30-year mortgage will be paid off in 8 to 10 years. That's another exit strategy. There are so many strategies, but at the end of the day, it's all about buy and hold long term, right? I mean, I would never recommend selling the property too soon, if at all possible. But everybody's financial goals are very different. So let's recap. So if you have the discipline and the commitment to hold your property for long term, let the market ride itself out. Overcome challenges, overcome vacancies, overcome maintenance issues. Hopefully, you don't get too stressed out. You can watch your property grow over time. It's a get rich, not quick. Get rich slowly. So this is just one property. So you look at the other potential profit you can gain if you invest for the long term. I mean, you have to, everybody's financial situation is different. Some people can buy 10 of these great properties in good markets in Florida and Texas and North Carolina, right? I mean, do your research, do your due diligence, find a network such as ours that can help you do all these kind of things. So many possibilities, and the numbers does not lie. So this software is a very precise breakdown. Go over from year 1 to year 10, break it down to your income analysis base. Then it breaks down to your expenses on a monthly and annual expenses. Break down the income analysis to determine your net equity at any given time. But give you the annual cash flow, give you the the cash and cash return, the equity gain, the loan balance getting lower, and the market value of homes kept increasing from year to year. Loan balance steadily decreased. Then you have each year you have more equity potential, right? So a lot of exit strategies. You can cash out refinance, you can sell the property and pay your taxes, still walk away a winner. You can sell your property, do a 1031 tax deferred exchange to buy more properties and not needing to deferring your capital gains taxes. So, but at the end of the day, you got to pull the trigger, right? Do your research and due diligence. Surround yourself with a good team. Go through a network like ours. We can help you guys out there to become a very good passive investor. Even though this is buying a rental property is not really that passive, theoretically speaking. All right, so hopefully, I'll give you some, really a high level understanding. Understand the numbers conceptually. More. You do your research, get educated. At the end of the day, pull the trigger. Right? Overcome whatever challenges you have. Buy your first property. Have a good experience. Have a team to help you on the ground, wherever you the location, whether it's Austin, San Antonio, or Central Florida, or Southwest Florida, or North Carolina, Raleigh, Charlotte. Those are, in the South and Southeast, mainly are the good markets. That's our, even in Alabama as well. Single family homes, sometimes duplex, triplex, fourplex, in newer locations, brand new construction will be ideal. Single family home is the best. It's the most, income property is the most historical proven asset class in history. Okay, with leveraging, with tax benefits, appreciation potential, principal pay down, letting the tenant to make you rich, pay down. Your tenant is making you rich. Really think about that. So, all right. So thank you so much. Hopefully I'm not overwhelming you with all this numerical analysis, but I try to simplify my explanation in a very conceptual way, numerically speaking, because it really is all about the numbers. I know there's more aspects to it than that, But okay, hopefully that's helped. This is SeeWing Yee from the Yee Real Estate Network. Thank you for listening, and I hope you can go over your financial plan and pull the trigger and become a real estate investor and buy and hold long term, and you should be able to achieve your financial dream and your financial freedom for yourself and your family. Thank you so much. Have a nice day. Bye-bye.